Good day, fellow deal makers. Welcome to the Deal Scout. On today's show, we're going to have a conversation about SPACs. What the heck are they? When to use them? And we're going to have a conversation today about this with Michael. Michael, welcome to the show.
Good to be here. Thanks for having me.
Yeah. Now, do you prefer Michael or Mike? Like, what do you prefer?
I always say just don't call me late for dinner. I've gone by both. I'm more Michael right now, but I'm happy with Mike.
Okay. What does wife or mom? What do they say when you're in trouble?
Oh, geez.
It's the full name
Well,
then.
words I won't use on this podcast or Michael.
Okay. Well, I'll call you Michael. Michael, so on this show, we're going to talk about deals and deal makers and kind of get your story. So why don't you kind of kick us off with getting us, give us the opportunity to get to know you, kind of give us your history and what are you focused on?
Sure. So I've had an eclectic career, almost entirely in deal making, but all the different aspects of deal making. So prior to grad school, did some strategy work. Then post grad school, I was an M&A lawyer at Skadden. Then I was an investment banker at Merrill. Then I spent about 12 years working at big tech and information services companies, primarily in corporate development and strategy roles, although I also ran a couple of businesses. So I was at VeriSign, I was at GE, I was at a company called IRI, a big market research firm, and then finally at LexisNexis. Then I spent a few years as the CFO of some early stage companies, so more on the sell side. And then about 7 years ago, I joined Deloitte and spent the last 7 years at Deloitte running an internal team with a very jazzy name of the Deloitte New Venture Accelerator, whose job was to help Deloitte build its own technology businesses. So it was a combination of doing strategy work to figure out where we should play, and then doing what looks a lot like private equity portfolio operations work to help build those businesses within the firm. It's a totally different business model than professional services, largely driven by acquisition. So the acquisition was usually the foundation stone of these new businesses. And then finally, and along the way, I've taught M&A at a couple of law schools, business school. I've written 3 books on M&A and spoken and written about it a lot. And then finally in December, in what is, I'm hoping, sort of the last big move of my career, I formed a firm called Trajectory Capital with 2 very close friends. And Trajectory Capital launched a SPAC in December, called Trajectory Alpha. And then in addition to that, we also do, separate from the SPAC, we also do some venture investing and growth equity as well.
Oh, wow. Okay, cool. So from your resume, it puts you about 133 years old.
Yeah, yeah, yeah. I've bounced around a lot. You know, it's interesting for me. I'm less interested in the role and the job title than I am in the substance of the work. So you can see throughout my career, the like single string is I love disruptive change in businesses, disruptive positive change in businesses. And the cool thing about M&A is it's sort of a cheating. It's like
Yeah.
it's like a cheat, right? You get to totally disrupt a business in a matter of months rather than a matter of years. So all my friends who are operators are like, come on, that's not, that's the easy path as opposed to just building it. But I love disrupting, whether it's through M&A or through new strategies or investments. I love disrupting businesses and sectors. So I've sort of, every job I've ever had did that from a different angle or perspective.
Very cool. When you were at Deloitte with their new venture accelerator, was that a corporate venture capital plug and play or
No,
what?
not primarily. We did a little bit of corporate venture capital, but very little of it. It was primarily identifying technology businesses that were highly complementary to the services businesses that we already had,
Yeah.
and then figuring out how you are going to build by partner your way into that business. So, good example, leading cyber defense and cyber consulting business in the market, well over $1 billion in revenue. Let's build technology capabilities that align to those, so we can either advise you on how to do your cyber defense, or we can run it for you using our own technology stack. Inevitably, you are likely to do some M&A as part of that to jumpstart the strategy. But yeah, I'd say corporate venture was a source of potential deals or potential partners, but it wasn't central to the strategy. The center of the strategy was, we want to be in this business. We think we have an edge because we are already in the services side of the business. How do we build that? We can acquire, we can partner, we can organically build, and the standard strategy process for figuring that out.
Yeah. And innovation, man, it is, especially for a big group that, that has traction or something, innovation has to be an initiative. It has to be a focus. It's not going to happen
Yeah.
organically, right?
No, inertia is incredibly powerful. Ironically, the more successful an organization is, the harder it is to just get innovation started because things are going so well, right? If you're at the edge of a cliff, everyone becomes innovative real quick. But when you're doing really well, it's hard to drive people to be really innovative. And so you're absolutely right. You need a purpose-built team who's going to focus on it, right? That's got to be their day job. Because if it's not their day job, if you're successful, you'll have other stuff to do, especially during a hot market, right? The last 4 or 5 years, actually the last 10 years, have been a very active market. There's a lot of just basic organic opportunity to explore, So in that kind of environment, getting any organization to focus on disruptive innovation requires, as you said, sort of a dedicated focus team.
Mm-hmm. Now, you've been on all sides of the coin when it comes to brokerage: build, buy, raise, invest, legal,
Yep.
raise, the capital side. Like,
Yep.
in your experience, like as you were exploring these different sides of the deal, because you like disrupt, like your common theme is innovation, disruptive, helpful, things that are good,
Yeah.
innovation, right? From all the sides on the deal table, which do you think you best fit and most enjoy?
That's hard to say because I like them all. I'd say that the place that I'm probably the happiest is identifying the opportunity and figuring out how to put all the pieces together.
Mm-hmm.
So and that's why I've ended up as a principal investor, because the other parts of the deal are super fun, but there's something about finding a company, figuring out how you can take them from good to great, and then helping them get there. And I'm very low ego, so I don't need to be the CEO. I don't need to be in control. I want to be part of that journey, and I want to be helpful. I find that super fun. It's part of the reason I sort of think of companies as having 3 fundamental risks to them. The first risk is the market doesn't want what you're putting together, right? There is no addressable market for it. Either it doesn't exist now or it'll never exist. The second risk is whatever it is you have, nobody is not good. It doesn't work. It doesn't address the need. And then the third risk is you can't operationally execute and grow. I love the third one. And the reason I love the third one is it's totally in our control to solve that problem. So I can't really it's very hard to create an addressable market out of nothing, right? Yeah. Rare companies have come along that have been able to sort of create their whole new market. But for the most part, you need the customer need. And even they, I would argue, are just addressing an unmet need. So the need's got to be there. And your technology has got to solve the problem. And since I'm not primarily a technologist, that one to me is a little bit of a black box. But once you've solved those two, right? Billions of dollars available, the thing works. The process of turning that from a small business into a big business, to me, seems eminently doable and super fun. So I love to identify that opportunity and then lean in with that team to sort of, and that can be, and that's where the diversity of my background helps. It could be scaling up our sales organization. It could be figuring out our pricing because we know it's wrong. We got to develop product management because we got to expand our product. We need a stronger management team. We got to figure out how to build an ecosystem strategy. We got to figure out how to build an M&A strategy. We want to grow more aggressively. Those are all really fun problems to me. And not that they're easy, but they're doable, right? It's the difference between, digging a hole is in my control. Learning to fly is not.
Yeah.
You know?
So I love this. In the, I interviewed a guy named Les McEwen, and he talks about the startup struggle. And there's different stages of a business, right? Like to start up, we're trying to figure crap out, and then we start to get systems and processes. Now it's about scale, and then you have to innovate, or you're gonna die, right? Yeah. So in this, right, you step into a table and you dive in. Do you like taking something from like an idea and a concept to a one, or do you like taking something and really working on that growth and trajectory side?
It's the second. I think, in fact, that's part of the reason our firm is called Trajectory. It's not to say there are other people who I think do a better job of having the spark of an idea. And maybe it's my finance and legal background, I'm sort of a natural cynic. And so it's hard for me to do that thing that entrepreneurs do, where they go, I'm going to disrupt a whole industry and forget about, IBM and Apple. I'm going to eat their lunch. That requires a level of sort of like open-minded thinking that I'm not as good at. So, it took me 53 years to figure this out, but I'm sort of self-aware about it. So the part that I love is, okay, you brilliant entrepreneur had that spark, took that chance despite all the odds, and you've hit a certain level of proof point, right? And the proof point doesn't have to be that big. For me, the biggest proof point is your addressable market is large, right? You haven't solved the problem that Josh is the only person in the world who has, because, okay, that's fine, but that's not a business. And secondly, you can show me enough smart customers that clearly are happy with the result, that it's not an accident or a whim, or you didn't talk your cousin into buying it because your cousin owed you a favor, right?
Yeah.
When you hit that moment in time, now it's fun, because now you can hit the gas, right? Now it's all about taking the thing you sold to 3 companies and figuring out how to penetrate another 50 or 100, and figuring out how to add on functionality so that you can charge more for it. And were you charging the right amount to begin with, or did you give it away because you were just happy to get a client? And is your team going to be able to support all of this? Gosh, when you had 4 people, you sort of figured out HR. Now you're about to have 100 people. How do you deal with HR? Like, I can just go on and on. It's all these sort of, how do I go from, little to big problems that are super fun to solve. And they're especially fun to solve with an entrepreneur that needs that help, right? Because honestly, the reality is, if somebody doesn't need the help, you might still invest in them because it's going to be a great outcome. Oh, you've created the next Google and you don't need any help and you're all set. I'd still like to put some money in, but I'd much rather be, from a selfish personal perspective, I'd much rather be in a situation where you need some of my help. I don't know where you're going to, maybe you need my help here, maybe you need my help there, but that's what's fun for me. And that's honestly, my partners and I are building a firm based on that premise, that we're all we call it operators for operators. We're all operators because we love to wrench on businesses. So we're low ego. We don't need to be in control. You can tell us where you need the help. But my observation is, an entrepreneur that says they don't need help anywhere probably doesn't have a good handle on their business. There are no early stage businesses or even growth stage businesses that don't need something, that can't tune something. So you figure out what that is, and then that's where you go.
Yeah. So you mentioned this a few times, right? Like, I believe you spend a lot of time on self. You say, I'm self-aware, low ego, natural cynic. I know what stage of the business, I know what, where I should put my focus. Were you always that, or did you have a wake up call one day saying, I need to figure my stuff out?
I'd say it was a journey, and it took me way too long. This is actually the biggest. This
Me
is the
too.
biggest piece of advice I give to either alumni of my alma mater or other younger people that I meet. Is I say, look, figure out what you enjoy doing, not like the job title you want to have or the industry you want to be in. Like, on a minute to minute basis, what do you enjoy doing, and what are you good at? My suspicion is those two are highly correlated. Some people love to talk, some people love to present, some people love to like kibitz and engage, right? Whiteboard time, super fun. Some people like, I want to be left alone and I just want to crank numbers, or I want to be left alone and I want to work on words. Once you figure that out, number one, you'll figure out how to be incredibly impactful, but number two, you'll have fun. And at the end of the day, that's, like, I always say, especially now that I have a daughter, whatever I do, 10 hours a day, better be good enough to justify that I'm not hanging out with her. right? Because that is the fallback. So I better be getting a lot of joy out of what I do. But yeah, it took me a long time to figure those things out and to refine them, right? You know, even down to the fact that I moved from a 130,000 person organization to a 4 leaning towards 6 person organization. You know, I think was a recognition that at least at this stage of my life, I'd rather be with a tight group of partners, working with a couple of management teams and making their businesses better. But yeah, it's I did not get to it quickly. I bounced around a lot, and I probably did some things that weren't as fun as other things could have been. So yeah, I think that's an incredibly important insight. That self-awareness that is not colored by what other people expect of you, right?
That's huge.
Yeah, yeah. Like honestly, and I was an investment banker, and I had a lot of fun as an investment banker. It's a very impressive title. Oh, I'm an investment banker, right? And there's certain firms on Wall Street that are very impressive firms. I know people who work at those firms. I was just talking to a college classmate of mine who spent 22 years at one of the highest end firms on Wall Street. Love it. It's where he was born to be. He's super happy. I know other people who went there because of the name, miserable, right? And it took them time. So if you do nothing else, whatever job you're in, figuring that out about yourself will accelerate your success and your joy.
Yeah, no, I think so. You mentioned books, right? Good to Great. They talk about the hedgehog principle, right? What are
Yeah,
you good at? What is there a need for? And how do you make money doing it? If you could figure
right.
those out, you're kind of like in your sweet spot.
Yeah.
It took me, I'm 40 now. My most common message that I've gotten on LinkedIn was like, congrats on the new role. Like I'm like,
Yeah.
sometimes I look back and I go, gosh, I've heard that like 40 times from the same person. And figuring that out as a deal maker, right? So this
Mhm.
show's about deals and deal makers. Figuring that out as a deal maker, it's like, what is your greatest skill set? What could you bring to the table? Who are you actually serving in this? I think is
Mhm.
super vital because we've all seen the people who are absolutely miserable with a Lamborghini in their driveway, but they don't have time to drive it
Absolutely.
or to
That's
drive
right.
it with, you
Yeah,
know?
that's right. Yeah, and listen, the flip side to that is being a workaholic works for some people. I'll give you the extreme example. I actually just posted about it on LinkedIn. So my mom is still working about 45 hours a week at the age of 96.
Wow.
Yeah. So my mom's a huge badass. She retired from being a full-time law professor at the very young age of 94, but then continued with writing and speaking. She's on Zooms all the time. She's working on 2 books and a bunch of articles. So, there's nothing wrong with, working and working a long time if that's what makes you happy. The people that really traumatize me are not necessarily the people who are working long hours. They're people who clearly are not happy about it. You know what I
Yeah.
mean? That's, and you have to find balance. You have to make sure you have time for your family and time for other things. But in this new role that I've taken on a couple of months ago, I wake up on a Saturday morning. I'm like, oh, that's an idea. Oh, I got to write that down. I'm constantly because I'm having fun doing it.
Yeah. I think that's important. And I think other people feel that and they'll naturally gravitate towards people who are in their sweet spot in life,
Yeah.
right? And
Mhm.
that's a great way to build a team. That's a great way to build culture. That's a great way to, your spouse probably likes you better too when you're doing something that you love, right?
Absolutely. No, I think you're a better spouse. You're a better friend. You're a better parent
Yeah.
if you're happy in your work.
Yeah.
Totally. Yeah, because there's no way to bifurcate it, right? If you spend 40 hours a week or 50 hours a week feeling like you're getting hit over the head with a mallet, you're not going to walk, in my case, when we're all working from home, walk downstairs to the dinner table and go, oh, I'm in a great mood now.
Yeah. Yeah. Now, I'm an entrepreneur through and through. I found out that I'm a really shitty employee. I did government work. I worked at big corporations and I just like the bureaucracy, the politics, the climbing a ladder. Like I learned through the hard way. I had to try it myself. I'm that kind of guy who had to figure it out for myself, but I'm just really good in the deal making side, connecting with people, keeping things small, and I enjoy that more. It's more of who I am.
Oh yeah, yeah. Well, and that's the thing about sort of driving your career is there's so many different axes and you have to figure them all out. So like if we take you as an example, you figured out that you liked M&A and you like deal making. Well, that's one because you like the dynamics of that, right? Negotiation, fast paced, whatever it is.
Yeah.
But then there's also big organization, small organization, right? There's also control transactions, non-control, right? Control is you're in charge, you're driving. Non-control is I review stuff as it comes in and then I make a choice, right? So even within deal making, you haven't chosen the optimal career path. You have to go like a couple of layers deeper to get to the version of deal making that's good for you. And I know I have friends, by contrast to you, I have friends who work in 200,000 person organizations doing M&A, huge amounts of bureaucracy, huge amounts of process, and they're super happy, right? And they would find what you're talking about to be traumatic because wait a second, where are my 100 bodies around me?
Yeah. I remember I went to dinner or something like that with a wife's friend. We were doing a couple thing, and he was asking me. He's super analytical CFO, right? And I'm like, how's this gonna work out? And he's like asking me questions, and he started getting like almost an anxiety attack when I was talking to him about the different ventures that I was involved in. He's like, how in the world do you do that? I was like, it's who I am, man. Like I have to be on this this side of deal making and innovation and investing and risk.
Yeah.
You know, um, behind you, you mentioned books, right? You've written 3 books. I see a few books. Are those your books? Give us a pitch of the books you've written.
Yeah, some of them are my books. And one of them is one of my books in Vietnamese. Although since I don't read Vietnamese, I'm assuming it's my book and not something else.
Yeah.
Yeah, I've written a book called M&A Deal Makers and another book called M&A Basics, which are, in both cases are designed for someone who doesn't have incredible depth in M&A, but for whom M&A is going to become an important part of their life. So that could be a more junior person who's going to be an M&A specialist, M&A lawyer, M&A banker, or it could be a senior executive who, that's not their day job, but it's going to become their day job, right? If you're about to sell your company or you're about to start doing a roll up and acquiring a bunch of companies, yeah, you're not the banker on the deal, you're not the corp dev officer, but you probably want to understand basically what's going on, right? Who are all these people? What are they doing? How does the process work? What are the sort of touch point dynamics that I should be thinking about, right? One that I always am amazed people don't think about is the asymmetry of information between buyers and sellers, right? Sellers, I don't think spend much time thinking about the fact that the poor buyer is in this crazy position where you've been running your business for, let's say, a decade. You know everything about it. You're asking the buyer to give you a gigantic bag of money. And if you set aside legal defenses and stuff like that, basically, once you get the giant bag of money, they're never getting it back, right? It's a one-off, gigantically risky transaction. And you know this much, and they know this much. And that dynamic drives how you do disclosure, how you do diligence, how you do even structuring and negotiation. And so just having that realization as a seller, okay, if I put myself in the shoes of the buyer, that's their big fear, is that they turn over a rock 2 days after they buy the business and discover a gigantic hole. And I think that recognizing that makes sellers better sellers. You know what I mean? So it's stuff like that that I put in the book in the hope that people would read it and it would make them either more effective early on in a deal-making career, or it would make them more effective as a general business executive who's sort of on the periphery of the deal-making world, right?
Yeah. So, but you mentioned 3 books. What was the other one? I see.
Oh, the first one was called Deal Teams, and that one has sort of been restructured into Deal Makers. So there's a fair overlap between the two of them. Deal Teams was my book I wrote 20 years ago, like my first attempt at a book. So it's I think at this point it's out of print, but Deal Makers is basically the updated version of it.
The 2.0. Now I'm looking on the bookshelf behind you and I see some is that electronic equipment or something? Is that a turntable up there?
That is a turntable. I am of the vintage where I actually started my music life listening to records.
Yeah.
And I still have a bunch of vinyl in the bottom. In the bottom over here, you can probably see like a handful of vinyl.
Yeah.
So yeah, and that's the turntable is new because my old one is in need of repair. But the rest of that system, the NAD receiver and the B&W speakers, are my largest life purchase at the time in 1986 when I was going to college. Because when you're going to college, what you need is just a real hardcore sound system. So,
Yeah. Now, if I thumb through some of your vinyl down there, some of your records, like what will be some of the titles that I see?
well, here's the important caveat to this: is remember, these are all my purchases in the 1980s, right? Because I moved to digital like everybody else. So there's a skew here, but it would be a lot of heavy rock, a lot of like Zeppelin,
Yeah.
AC/DC, stuff like that. Kansas, uh, a little bit of like more funky stuff like Al Jarreau. You know,
Super interesting. So I grew up listening to vinyl because, my dad was a huge fan. On the job site, we were in construction. He didn't carry around a vinyl, player or anything like that, a record
right?
player. But we would grow up listening to oldies. And in the house, we had a record player and we would listen to, comedy, old school comedy, and then 45s. And then we would listen to, but I actually like the sound of records.
Hmm.
The scratchiness, the, the, the flow of the music, I think
Yeah.
is interesting.
Oh, absolutely. And I'm sure for my daughter, she'd be like, why do you want to listen to music that has imperfections? But I totally agree with you. I think it's a richer sound, and the imperfections sort of make it feel like you're listening to music. Maybe it's just because of the way I grew up, and it sounds like you did, although you're materially younger, but so your dad did you a good service by giving you access to that.
Yeah, yeah, I think it sounded good, and the scratch, you could almost, especially if it's a little warped, it creates a cool little, like, it makes its own
Yeah,
little beat with the warp in it.
right.
Anyways, back to deal making. So you guys are, with Trajectory Group, Trajectory Capital.
Yep.
Do you ever have a hard time like spelling that? Like where you have to like go is it D? No, J.
Yeah. You know what? At this point, I never type it because it's like it's in every standard email that I have.
Right.
But yeah, we wanted a name that sort of suggested growth and disruption, but not irrational, right?
Yeah.
So we're not creating teleporters. We're really interested in sort of core business operations, and frankly, and this is one thing that I find very appealing, the notion that something can be disruptive without being totally new,
Yeah.
right? I mean, there are so many examples of that. One of my favorites, iPod. The technology in the iPod was not new, right? I don't know if you did, but I had weird devices before the
The
iPod.
Zune or something
Yeah,
like that. The MP3.
exactly. It was the application of technology in a disruptively better way. It was taking something, and now you see that I play mostly on the B2B side. You see that with the application of AI. So it's great that you have AI technology. What's the business problem you're solving? And that requires some actual thought, right? You have to really understand the business problem. You have to really understand the tech. You have to put those two things together. So there's all these opportunities for real massive disruption with technology that already exists, that's out there, right? You can certainly go out and create new technology, and if my father taught at MIT for 40 years. There's a whole bunch of people at MIT creating stuff that I can't even imagine right now. But from the moment that a new technology is created, there's this massive multi-decade journey to figure out all the ways to use it,
Yeah.
right? We're in the first inning of figuring out how to apply AI to business.
Yeah. And blockchain and crypto and self-driving cars and solar crap. And
Yeah.
so you guys got together, you and a few partners,
Yep.
and you said, okay, let's do this. We have our venture where we invest,
Yep.
right? And then we're gonna focus on a SPAC. Let's
Yeah.
talk about SPACs. What
Yeah.
the heck is a SPAC, and how is it a good tool for
Sure.
whom?
So SPACs have actually, this is the funny thing, SPACs have actually been around for decades. But there was a gigantic rush. They sort of recreated themselves, and there was a gigantic rush of volume of capital into SPACs starting a few years ago. My best analogy, because I'm an old guy, is what happened with venture in the 90s, right? Venture capital had existed back in the 80s, 70s, but something happened and suddenly it became a much more powerful asset class and money poured into it, and it sort of evolved, right, from something that was pretty nichey to something that's incredibly common. Same thing sort of happened with SPAC. So at its simplest level, a SPAC is a publicly traded company. It's listed on New York Stock Exchange, which is where we're listed, or NASDAQ, that contains a bunch of money. And it's actually a special purpose acquisition company. It's got a single purpose in life, and that purpose is to find a private company to merge with. And that's literally the life cycle of a SPAC technically. A SPAC is IPO'd through the standard IPO, SEC IPO process. Capital comes into it. It has a sponsor team. That sponsor team also has to contribute capital for the operations of the SPAC. The money sits in a trust, and that sponsor team has some period of time, 18 months, 24 months, to go find a company and to complete a merger. And at that point, and the investors in the SPAC have the opportunity, the money sits earning interest, T-bill rate or whatever the investment is, but a conservative investment. The investors have the choice to take their money back out, or if the SPAC never finds a target, they get their money back and they've earned this very low interest rate on their money, or to keep their money in the SPAC and it converts into a shareholding in this actual operating company. So, excuse me, that's sort of the dynamic of the process. So it's a very, very straightforward process, right? You do an IPO, you have a public company that has money in it, you find an operating business that is private, the two merge together. The result is a public company that has real operations, does whatever that private company did. The shareholders in the SPAC become shareholders in the public company. The shareholders in the formerly private company become shareholders in the public company. And then it's just like any other public company. It's a widget maker, it's a software company, it's whatever it is. So it's there's a lot of legal documentation behind it, but at the core, that's all it is. The real question in my mind is, and this is where I think people need to spend the time, where is a SPAC an effective tool? SPAC is a capital tool like any other capital tool. I can get a bank loan. I can do a traditional IPO. I can get venture capital investment. So there's all kinds of different ways to provide capital to a business. The question is, where is the SPAC the right avenue? And I actually think, I'm going to say this now, that's the wrong question. It's not to SPAC to be Shakespearean. It's not to SPAC or not to SPAC. Really, any company, any private company should start with, where do we want to go? What do we need from a capital perspective? And what's going to help us to be the most successful? That will then lead you down the path of, we don't need capital. We do need capital, and private sources of capital are better. We do need capital, and a public source of capital is better, right? And those choices have to do with a variety of variables that are specific to the company. Do we need capital to grow? Do we want to remain in control? What are we going to use capital for? Do we want to do M&A? Do we want to grow organically? Are we prepared to either, on the one hand, have a single or small group of investors who are going to be much more involved in our business, maybe have control of our business, or are we prepared to be a public company where management team has a lot more control, the investors are a lot more fragmented, but you have all the requirements of being a public company. A private equity fund is probably more understanding about volatility in your business model because they understand it better. The public market isn't researching your company as clearly. Individual investors are, so they're going to be a little more startled by missing earnings calls and projections. So there are all these kinds of substantive variables that have to do with the business and where you want to take the business, right? A SPAC isn't an end it's a tool to an end. The end has to do with your product, your customers, your revenue. So in my mind, companies start with public or private. Once you've decided we want to be public, and there are a variety of reasons to be public. We've achieved a certain scale. We want to offer liquidity to our employees, to our investors. We want a public currency with which to acquire and raise capital. We want the brand of being a public company, which can be helpful. For whatever reason you've decided public, then you choose of the different avenues to go public, and one of them is a SPAC. The advantages of a SPAC are you generally can get public much faster because the entity is already public. You still have to go through shareholder votes and things like that, but the process tends to be substantially faster. I would argue, although people can debate this, it's a higher likelihood of an outcome. Because you've already got a public entity and an investor pool that specifically invested with the goal of merging with another company, the likelihood of achieving a SPAC, of getting public, is higher. Although again, people can debate that. And then there's the last variable, and this is one that I think is the most important, but I think it's not every SPAC that's like this. So you sort of have to assess the SPAC, which is the operational help you can get from the SPAC. So there are SPACs that I think even they would be self-aware enough to say, basically are a mechanism to go public. We're not going to help you. We're not going to do anything. We're going to help you go public. There are probably some SPACs that don't say they're that, but actually are that. My partners and I, and this is not an attempt to advertise for Trajectory, but just sort of, it comes more from our personal characters. We have chosen to be very operational, right? The three of us are all, we actually call it operators for operators. The three of us have all spent our careers running businesses. And so one of the benefits of working with us, if you think we can add value, if we think we know your space, we're smart, you want the help, that goes back to the point at the beginning about wanting the help, we can be a value add, both preparing to be a public company, because that's not easy, and executing all those growth plans you had, right? Oh, we want to be public so that we can execute an M&A strategy. You know, good news and bad news. You're now public, you have a public currency, and M&A strategy is a lot of work. Who are you going to go after? How are you going to value them? How are you building your business? How are you going to integrate them? So that's sort of the third component of a SPAC, is a SPAC team, depending on whether they are operational and whether they happen to align with your business, right? So they could be, you know, you're a biotech and they are world-class experts in ice cream manufacturing. Maybe they won't be that helpful to you. So, but if they have the right expertise and you want the help, that's the last part of a SPAC, is they can be additive to your operational needs, right? They can be advisors, board members. You might even use them to help, you know, hire the rest of a management team. So if I go out all the way to the beginning, you know, I think SPACs are just another tool for capital, like all the other ones. And, you know, my advice to any company that's thinking about it is, don't start with to SPAC or not to SPAC. Start with where am I trying to take my company over the next 5 years? And you sort of, it's like branches in the road. You know, you decide based on that business goal, I need capital. You decide I would like to be a public entity. And then you decide, I think the SPAC is the best mechanism for becoming a public entity. That's the smart way to sort of get to the use of a SPAC, if that helps.
Yeah, super helpful. So to SPAC or not to SPAC, in that, let's ask a few questions. Let's peel that through, because this helped you guys make a decision. Hey, we're going to start our own SPAC. So these are questions that target companies that are private, that will one day maybe want to have a liquidity event or grow. And there's so many different benefits of using the SPACs, but there's probably risk associated too.
Oh yeah.
For a target company. So I have a private business. We're doing great. We're looking to scale. What's like the minimum, or what are some requirements that a target company must have to even make sense for a SPAC?
So everyone will debate size. My personal view is, if you have less than, you know, 30, 40 million in revenue, it's tough to justify going public. And this has nothing to do with being a SPAC. And maybe a better way of saying it is, I think that in order to be a public company, you need to have a certain level of stability in your business model and your operations. because the public market is going to expect a certain level of predictability. And so you need to be able to say with a straight face, I can generally predict quarter to quarter how my business is going to do. I have a handle on it. I don't have uncertainty about whether there's an addressable market. I don't have uncertainty about generally how my sales team is going to perform. I've got my pricing sort of dialed in. You know, you'll continue to grow and innovate, but the core of your current business, you sort of got a handle on it. And if you don't, being public will be a disaster, because the public markets don't have the same tolerance for uncertainty that VCs and private equity investors do. That's why private capital exists, is to provide capital to companies that aren't ready for the public markets. So, you know, there's no magic revenue number, but I would argue that if you haven't been generating a material amount of revenue for a significant number of years, you probably haven't worked out all those kinks yet. So, you know, if you think you have, great. But that's the other thing is, I think the public markets will look for a history. In these times, sometimes they can ignore that if it's a super hot company. But as a general matter, they'll look for a track record, because the public markets want more predictability. So, you know, I can't give you a revenue, a hard and fast revenue number, but I'd say, you know, maybe this is a good test. If you don't think you have a mature, strong management team that could stand up in front of an analyst call or on CNBC and sound like they know what they're doing, they understand their business, and if you don't have enough of a handle on your business that you can't project with reasonable comfort on a quarterly basis, revenue, profitability, new customer acquisition, price trends, things like that, you're probably going to be better off. It's not a question of whether you could or could not go public. And there are SPACs right now that will take people out like that. It's the catastrophic event after you go public, when you miss earnings calls, when analysts start to question the skills of your management team, all that kind of stuff, that will actually, ironically, damage your business, because you won't have the privacy and air cover to fix all that stuff.
Yeah.
You know?
Yeah, absolutely. Now, in terms of preparing, so target company, you know, I have a private company, and I'm
Yep.
like, one day I might want to go the public route. Don't know, but it takes a while to get my audits, my financials to be ready for a SPAC to be able to partner with me, merge me, buy me, right?
Oh yeah. Well, it's way more. It's that, but it's way more than that. You have to have audited financials. You have to have a really good handle on all your financial metrics, and not just financials, but also all your operating metrics. All your legal materials got to be in order. All those customer contracts, all your intellectual property rights. You've got to have a strong management team. You've got to have HR and talent policies, right? There's a whole bunch of stuff that is the hallmark of a sort of mature company. And you need to have all of that set up in order to be ready, in my view. Again, other SPACs might have a different view that we'll just take whoever out. But in my view, if you want to have a successful public company, you need to have a lot of that sort of infrastructure, muscle tissue built out before you go. And that's actually one important point I'll make about SPACs. There are sort of two economic events that happen with the SPAC. The first one is the moment of what's called de-SPAC, when that merger happens, right? So at that moment, the two companies come together, it's now a public entity, you're off to the races. And SPAC sponsors can generate a decent amount of economics just at that moment. Frankly, without getting into details, we structured our SPAC to skew our personal economics away from that moment. Because in my mind, if you merge with a company and the stock craters, you didn't do a great job. You don't deserve a windfall. So, the actual moment of de-SPAC in my mind is less important than how the stock trades over the first couple of years. And for the company, that's important, because this is another thing to remember. When a SPAC merges with a company, as a general matter, they are purchasing 5 to 20% of the company, right? There are different ratios, different SPACs do different ratios, but generally speaking, SPACs are always a very small minority of the total company. What that means is if you do a deal with a SPAC and they value your company at X, they're not actually valuing your company at X, they're valuing 10% of your company at X. Once you start trading, the public market, and by the way, if you have control over the public market, let's have a private conversation, because we can make a lot more money. Nobody controls the public market. The public market's going to determine your valuation.
Yeah.
And since you are probably locked up for a period of time, if I value your company at $1 billion and we go out at $1 billion, yeah, I bought in capital for 10% of your company at $1 billion, let's say. But then when you want to get your money out as management investors, you're going to get it out, let's say 6 to 12 months after that event at whatever the stock price is at that point. So if the stock price goes from 10 to 2, you've just destroyed a huge amount of value of your company, right? That's what people, it's not like an M&A transaction where I'm going to buy your hat for $100. Once you have the $100, you don't care what happens. This is, I'm going to buy 10% of your hat for $10, and then we'll see what everyone else thinks of the hat, and that'll determine the real price.
My hats are not for sale.
It's a wise move on your part. That's a great example of an asset that should remain private. But
my
yeah,
hats are private, very private to me.
The private assets. But yes, I think that it's very important for companies, if they're thinking about number one, if they're thinking about a SPAC, make sure you understand how a SPAC actually works. A SPAC is not buying your company. A SPAC is investing a smaller amount of money in your company and bringing your company into the public markets, at which point your stock will trade however your stock trades. So I'd put a lot less focus into the valuation the SPAC gives you, and a lot more focus into how are we going to make sure the stock trades well, that the market understands our strategy, that we can explain it to them clearly, that we're ready to be public. Going back to your earlier question, I think the prep thing is massively important. And the problem you have is companies that are growing well tend to be under-resourced and understaffed because they're growing. They tend to be laser focused on the core of success, which is usually building stuff and selling stuff. And that's all fantastic, except if they want to have a liquidity event, whatever that liquidity event is, some of the things that will make that liquidity event successful need to happen a year or two before the liquidity event. And the failure to do those things can fundamentally damage the value. The example I often give private companies is, I can give you some basic, you spend 10 years building your company, 10 years of sweat and labor and effort and investment. There are some basic things you can do that will increase the end value of your company by 10 to 30%. Why would you not do those things, right? It's the equivalent of throwing away 2 years of your work.
Yeah.
Right?
Yeah. What are some, 2 to 3 things that you can do right now to start increasing the valuation of your business, like right today?
Sure. So, number one, management succession, especially if you're gonna do anything other than sell to a strategic. The worst thing in the world for me as a buyer is to find a CEO who is about to get not just house money, not just boat money, but plane money, who is the crux of the business. And because there's no indentured servitude in this country, which means once I hand that person 10, 20, $30 million, if they decide they don't want to work anymore, they can. And if I am worried that's going to damage the business, I'm going to drop the purchase price to make up for that. So have layers of management and succession ready. Document everything. This is particularly true for financial stuff and for legal stuff, but also for technology stuff. Document everything. Anything that only exists in a brain in your organization is a risk factor to a buyer. So, number one, you want to have layers of brains. So when I give Josh plane money and he disappears, I want to have Fred or Susan right behind him that is primed to take over Josh's job and knows the same stuff, but also everything Josh knows should be written down somewhere in addition to that. industry standard stuff, right? This is a giant category, but think about who if you're going to sell to a buyer. And by the way, while I'm doing a SPAC and trying to take a company public, the vast majority of liquidity events are M&A, right? That is the majority. So you're in all likelihood going to be sold to a buyer. Doing things the way the buyer does them will make it so much easier for the buyer to absorb you. And everything. It's the way you document things, the way you price things, the way your contract terms, the way you architect your technology. The more you do that in a way that's digestible by the buyer, the less they're going to ping you on price. So those are probably the biggest things. And then there's a laundry list of other ones, like very specific ones. Open source code drives me absolutely bonkers. It drives me nuts when I see a small company that uses open source code in the wrong way, because they don't understand that they saved themselves $100,000 of development time. But I'm not dumb. I'm going to spot the open source code, and then I'm going to put it into my financial model, because I'm a high cost provider. I'm a big giant corporate with very expensive humans. I'm going to put $3 million of redevelopment costs, plus the fact that I won't be able to sell this thing without getting sued. So I'm probably going to shut down sales, and I'm going to ding your purchase price for that. Mm-hmm. So, you probably, by saving yourself 100 grand, you probably cost yourself $5 million in purchase price. That's just one of the ones that I think is it's like such an obvious foot fault, right? Where you should know better, but you did it. And if you did it, fix it before you get to me.
Yeah. So when we talk about leadership, CEOs, right? What makes a good public CEO? Or when you're approaching a company, you're like, hey, we like you, like what you've done. Yeah. We're probably going to put new management into place, because the roles, responsibility of a private CEO versus public is very different.
Yeah. So for the most part, a SPAC's never going to swap out a whole management team, because that would just take too long, right? That's, I think if someone brought me a company that had a whole management team that were not a fit for being public, I'd say go take a couple of years more as a private and prepare yourself better, yeah. Right? But that said, what makes a good public company CEO that's different from private? Number one, a comfort being grilled, and being grilled by people who don't know your business that well, right? As a private CEO, either you have a captive board that basically does what you tell them to do because you're the founder, or you have a private equity fund that's in your shorts, but they're very knowledgeable, right? Because they own 30% of your company or 60% of your company. So they've taken the time to understand. And B, it's not as the relationship isn't as dependent on impression, right? It's the difference between sitting and having a beer for 3 hours with somebody and hearing them for 10 minutes on a conference call, right? Yeah. So you've got to be good dealing with this sort of broad audience. Actually, before that, and most importantly, you just have to understand your business. You have to understand your business backwards and forwards, as does your CFO at the very least, right? Because you're going to get questions, and a bad news answer is bad, but I don't really understand your question, or I don't know the answer is much worse, yeah. Right? Because it comes back to the buyer seller thing, right? I'm an investor, and I don't really fully understand the business. I can't, because I'm a public market investor. If you don't understand your business, now I'm really worried, right? Because I'm betting on you. So key management really has to understand their business, and they have to understand the competitive environment around their business. And then they have to understand public markets, because public markets move for reasons that are different than private investors, right? They move based on broader trends that have nothing to do with your company. They move based on being nervous about different topics at different times, right? So something becomes an important topic, and it's either a big opportunity and investors get excited, or they get nervous. So you have to sort of get yourself educated in how public markets work. And then I think lastly, you have to be the kind of person who, and if you're not, this is where you may want to swap out a CEO, who really is comfortable having a handle on all parts of their business, because the CEO is the single voice. If you have a private equity investor, it's a lot easier to go, oh, for that question, I'm going to turn it over to Bob. And the private equity investor is like, fine, that's not what you do. The public market expects the CEO to have a pretty good handle on their whole business. And if you don't, they sort of lose confidence. So, and then I'd say the last thing is they've got to want it, right? You're presumably the CEO of a successful or CFO of a successful business. You're making good money. Things are going well. Being a public company CEO comes with a lot of work and stress, and it also comes with a lot of opportunity. But you've got to want to be in that position. If you don't, then you need to have a talk with your investors about, and this is often the case. The founder goes, you know what, I've had a lot of fun, but I don't want to be the CEO. I want to be the chief strategy officer. I want to be the chief innovation officer. We're going to bring somebody else in. And as a side note, one of the wisest things I see founders do is recognize their own limitations, right?
Yes.
I always thought Larry and Sergey were amazing. But when they brought in Schmidt, I was like, wow, that's an incredibly mature move, right? Nobody that wasn't a business in trouble. That wasn't a business where somebody came along and said, well, we need to put in some adult supervision. It was an incredibly successful business, and they had the maturity to say, even though we're rock stars, we could learn, and they did. So yeah, I think it's a very personal sort of decision at the CEO level.
Yeah, and I can speak from experience. Being a CEO, there's a certain level of ego that you get to actually build something, right?
Yeah.
It's the guy or gal who goes, hey, there's a problem. I'm the freaking one who could accomplish this, right? But as we learn and grow and get our teeth kicked in a few times, and then when we're looking at, now we have employees and we have their families and they have other things. Am I going to let my ego drive a decision, or am I going to focus on my team, the future of the business? So I love the fact that you guys say, we have a low ego approach where, we want to swing hammers and wrenches on businesses to make them better.
Yeah.
Let's do this. Two directions we could go with this, right? We could talk more in details about the operational side of a SPAC, right? So more into the details of a SPAC. There's a few questions that I have here. Or we can go more in the direction of what your SPAC is currently doing, why you guys set up a SPAC, and the direction you guys want to head, because we're running out of time. So which direction would you rather go?
I'd go the second one because I think it'll be more interesting.
Okay, let's go for it. All right. So what you guys have your venture group where you make, I assume, venture investments.
That's right.
And then you guys decided to set up a SPAC. Why? And what are you doing?
Sure. So, and this is probably different for us than for a lot of other SPACs because we're all operators. We have spent our careers working with private public companies. And our observation personally was we knew a bunch of companies that would benefit from being public. They, great product, they're getting great traction, but they're limited by an inability to do lots of M&A, an inability to pour capital, pour gas on the fire. And so we sort of came at it from the business problem perspective, which is, oh, wow, that's such a great business. Wouldn't it be great if they had access to a public currency? Wouldn't it be great if they had an ability to do M&A without pulling cash, right? That was how we approached it. And then we said, oh, SPAC, that's the mechanism for these companies that we already know. And we're not sure, obviously, and actually for regulatory reasons, we couldn't have direct conversations about this with these individual companies. So we're not sure every one of these companies is going to want to go down this path for all the reasons we just talked about. I don't want to be public. I'm not sure I want to do another 4-year run. I think I want to sell to a strategic. But we thought within the universe of companies that we know, that we love, that we're excited about working with, these are people who are friends of ours. We know they're the founders. We know the investors. This is going to be the right mechanism for at least a few of them. And it's a great way for us to work with them because it's a large enough transaction that it merits us spending all of our time. This is one of the challenges with venture is, for the most part, when you're making a very small venture investment into a company, it doesn't make sort of economic sense for you to spend dozens of hours with them, right? You can't possibly do that. If you're making 40 venture investments a year, the nice thing about a SPAC is it's one very large investment, which justifies us. And again, this is a self-fulfilling prophecy based on our personal needs. It justifies us spending loads of time getting into the weeds with them on how to scale, how to improve their operations, things like that. So for us, the logic chain was, wow, we know a lot of companies that need to hit the gas. Wow, a SPAC would probably be a really good mechanism to do it. And it would be a great way to allow us to spend really deep qualitative time with them, you know, and in a way that doesn't require a private equity deal and doesn't require them to lose control. They can keep control, they can put fuel to the fire, and we can get really involved in their business. That was sort of, you know, and again, this is a very personal thing for us because we all reached an age where we're like, we want to do what's fun for us. This is just the mechanism for us to do what's fun.
Yeah. So as you guys are going through this process, are you allowed to talk a little bit about details of your SPAC? You know, how much you guys have raised initially,
Mhm.
what kind? I know
Yep.
that you're not allowed to announce which targets you're actually looking at, but give us an idea of what would be a good deal for you.
Sure, sure. So the SPAC raised 172 million, which is in trust. That probably implies, there's no hard and fast rule, but it probably implies a company that's got enterprise value of at least $600 million. There's no real upper limit, but you know, some definitely north of 600 and probably south of, you know, mid billions. But that's a pretty broad range. What we are interested in is companies that, and I'll give you two axes: large existing addressable market, a disruptor in that market. So we want a company that is using technology, data, analytics to disrupt a big existing market. You know, better mousetrap. In terms of industry sector, we have a pretty broad range because of our personal experience. So it's anywhere that we have played. So that includes areas like ad tech and marketing tech, compliance, legal, cyber, enterprise back office systems, enterprise SaaS. So you know, there are a number of places where we've played. But the first metric is probably the more important one, right? It's the markets are, and this goes back to the discussion earlier. Three risks to a company. Does the market want a solution to a problem? Does this thing work? And how do we scale it? So we're looking for companies that have answered this question and this question, and we can help them with this one, in part with the capital that they get from being public.
Very cool. So you said you have a few partners. Talk to us about the partners and what kind of role, what kind of talent does each member kind of bring to the table, and why is it important to have a
Yep.
team?
So you know, I think it's important to have a team both for skill mix reasons, that you want it's going to be almost impossible to find one human being that has all the different skills. And also, I mean, this is going to sound sort of hokey, but you know, it's lonely to do something on your own. You know, at least I like working with other humans. So my partners are Peter Bordis and Paul Sethi. And they're both truly amazing people, and I bring the beer. Peter is a highly successful entrepreneur. He's built a number of different ad and media tech businesses. He's also a prolific investor in tech of different sorts, including ad and media tech. He most recently was CEO of Kubient, took it public during the pandemic. And I'd sort of say, without being too fluffy about it, he's really one of the visionaries in the ad and media tech space over the last sort of 15, 20 years. He's mentored a lot of the players in the market. He knows a lot of the players in the market. He's been an early investor in a lot of them. Then we have Paul. Paul spent some time at a hedge fund, then ironically bought a company from me when I was running corporate development at LexisNexis, and ran that for about a decade, sold it. He is also a prolific angel investor, has invested in a lot of very successful technology businesses. And then he founded a venture fund called 2048 Ventures, which was an early stage venture fund. So, you know, both, and then you've got my background. So there are some places where we overlap in terms of either industry sector or topic, and then there's a lot of complementarity to us. You know, we've each had different skills, right? Peter has been a serial CEO. I've been a serial CFO. Paul's been a very heavy investor. I've been more of an M&A acquirer. So, you know, we sort of found we blended together very well, but I'd be disingenuous if I said the first thing we did is matched resumes. Honestly, the first thing we did is got together and said, we trust each other, we like each other, we're trying to build the same thing. We want to do the same thing for the next 10 years. And then we said, oh yeah, and our resumes nicely overlap. But
Yeah.
if I had to choose partners, I'd choose it based on the first variables first, right? You like, you trust, and you want to do, and you're aligned in what you want to do.
Yeah.
And then you figure out who does what.
Yeah, yeah, I agree with that. I think it's so important to partner up with people that you like,
Yeah,
because you're going to spend a whole lot of time travel
absolutely.
and time and
Yeah.
family
Well,
meetings.
and it's different than being in a job, right?
Yeah,
They're my financial partners. We are in this together. There's no changing that. We co-own this, we make decisions together. So it's a lot more like a marriage.
yeah.
And that's a big choice that can be a very good choice and a very bad choice depending on what you do.
So you're married to two partners. Which one do you like better? No, I'm just don't answer that. I'm just kidding. I've got a few more questions, but one of the things that I like to do on my shows is I bought a bunch of cards that have questions on them, right?
Mhm.
Because my limited brain, I could only come up with so much. Tell me when to stop. I'm going to read you one of these questions.
Okay.
All right. So the question is, what's something about your life now that you would miss when you're 80? So many, many moons from now, what are you going to look back and you go, man, that was fun.
Having my daughter live in my house.
That's cool. That's cool. Um, as we're going through this, you mentioned people that were very important to you, your family, your partners, and I think that it's really cool. And one of the things that I want to honor you with is like you spend a lot of time trying to figure yourself out and being self-aware, and then also sharing that with other people, lowering your ego. So thank you for doing that for the deal community. Last question, two more questions. I lied. What question should I have asked you during this that I screwed up and didn't ask you?
I'm not sure you screwed up, but you know, one thing that I think is always an interesting topic is who should be a deal maker. Like,
Yeah.
and I say that because it's such a sexy industry. I think it often attracts people who shouldn't do it, and I always find that to be a shame. So that's probably one.
Who should and who shouldn't be a deal maker?
So I think the first step is self-awareness. What do you like doing? If you like digging into the substance of businesses and transaction dynamics, that's a good sign that you're going to like being a deal maker. If you just like getting things closed, I think you should be a salesperson. And there's nothing, I'm not saying that in the sense that there's something superior or inferior between sales and corporate development. The difference is sales is all about getting to close and much less about the terms, because the terms are usually much more set. Corporate development is about the terms and about the substance. It's much more bespoke. And I can't tell you how many corp dev people I know who really don't like any of that stuff. They just want to close deals, but for some reason they've got it in their head that sales is not the great place to go. I'd say the other thing is you have to like uncertainty and diversity. One of my running jokes was, if I wake up in the morning and I'm highly competent to do more than 70% of what's on my desk, I have a problem. I want to be like a little stressed by, oh geez, how do I do this? I've never done this before. And that's deal making is like that because every deal is different, every structure is different, every company is different. If you like that, it's great. If you don't, you're going to be freaked out all the time.
Yeah. No, I think that's so important because there's people who like consistency, who like structure, who like predictability,
Exactly.
right? They might do better in government or in larger organizations, in
Yeah.
enterprise.
Yeah. Or in some roles in enterprise, like there's certain technology roles that are about, 6 nines reliability, right? It's about getting everything to work exactly right. And then the last one I'll add is I think you have to be very low ego as a deal maker, because you are never actually in charge. You're an orchestrator, right? Number one, you're not the seller or the buyer. Even if you're in a corporate, the CEO is the seller or the buyer.
Yeah.
And generally speaking, if you're in a corporate environment, but even if you're in an investment banking environment, you are leveraging a whole bunch of people who don't report to you. I still remember when I was at GE, I did a deal once where I had 2 people on the deal team that actually reported to me, like I actually determined their bonuses, and 110 people on the deal team who didn't. Now this is GE, it was a very large deal team,
Yeah.
but the point is the same, that you have to be good at sort of, influencing and collaborating people where you have some authority because you're the deal maker, but you don't really have total authority over them, right? This is not their day job. If you don't like doing that, and you're not comfortable doing that, you're going to find it really stressful.
Yeah, and I never heard it put this way. There's a major difference between you might be good at sales, but you might not be good at deal making, or you might be vice versa, right? And I think that was super cool. So, last question: where can people go to connect with you and do a deal with you?
Sure. So I have a website, michaelfrankel.com, which also has some of my writing, podcasts, things like that. I'm going to put the link up to this. And then if they want to talk to me professionally, trajectorycapital.com.
Cool, cool, very cool. So, fellow deal makers listening in, we learned a little bit about SPACs. We learned about deal making and all sorts of cool stuff, and about ego and self awareness and all these cool things about which kind of deals should you be interested in and where should you be putting your focus. So I hope this was entertaining, educational, but as always, reach out to our guests and say thank you for being on our show. Find a way to do a deal with them. That's the purpose and mission of the show. And if you are looking at a deal or want to talk about a deal here on the show, head on over to thedealscout.com, fill out a quick form, maybe get you on the show next. Till then, we'll talk to you all on the next episode. See you guys.